What if I told you there's over $1 trillion of commercial real estate debt quietly sitting on a ticking clock, and many banks are pretending everything is fine? Behind the scenes, office buildings across the US are still struggling, vacancy rates remain elevated, and a massive refinancing wall is approaching between 2026 and 2027. The big question is, are we looking at the next slow-motion financial shock? Let's break it down. In commercial real estate, lenders sometimes use a strategy known as extend and pretend. Here's how it works. Instead of forcing a troubled property owner to refinance or default when a loan matures, the bank simply extends the loan term and hopes conditions improve later. On paper, this avoids immediate losses, but in reality, it can delay, not eliminate, the underlying risk. Right now, many analysts believe this practice is quietly widespread in parts of the commercial property market, and that's where the concern begins. The core issue starts with office buildings. Even in early 2026, remote and hybrid work remain entrenched. Office vacancy rates in major cities are still historically high. Property values in some markets have fallen sharply from their peaks. In simple terms, many office properties are worth less, but their debt was priced for a much stronger market. That mismatch is the pressure point. When loans mature, borrowers must refinance at higher interest rates, lower property valuations, tighter lending standards. For some properties, the math simply doesn't work anymore. Now here's the part that has analysts paying very close attention. A massive wave of commercial real estate loans is scheduled to mature between 2026 and 2027. We're talking about hundreds of billions, potentially over $1 trillion in debt needing to be refinanced. Why this matters? Many of these loans were originated when interest rates were near historic lows, office demand looked stable, property values were significantly higher. Today, the environment is very different. If borrowers can't refinance on reasonable terms, lenders face difficult choices: restructure, extend, or recognize losses. And this is where regional banks enter the picture. Unlike the largest Wall Street banks, regional and smaller banks hold a disproportionate share of commercial real estate loans, especially office exposure. That concentration creates a potential vulnerability. If property stress accelerates, these banks could face rising loan delinquencies, pressure on balance sheets, tighter lending conditions for the broader economy. Now, to be clear, this does not automatically mean a systemic crisis is imminent, but it does mean the sector bears very close monitoring, and markets tend to react before problems fully surface. There are several possible paths forward. Best case scenario: interest rates gradually decline, property markets stabilize, refinancing pressure eases, extend and pretend works as a bridge. More stressed scenario: rates stay higher, for longer office demand remains weak. Refinancing failures rise, banks begin recognizing more losses. The outcome will likely depend on Fed policy, economic growth, and the trajectory of office demand. The commercial real estate story isn't exploding in headlines every day, but beneath the surface, the refinancing clock is ticking. For investors and market watchers, this is one of the quiet risks worth keeping on the radar in 2026 and beyond. As always, this video is for informational purposes only and not financial advice. If you want deeper breakdowns on the biggest hidden risks in markets, subscribe to Finance Buzz with Harold, and I'll see you in the next one.